Good morning, dear friends. I myself, Dr. P.Arul, Assistant Professor, PG and Research Department of Commerce, St.Joseph College of Arts and Science, Autonomous Cuddalore. Today we are going to see about a comprehensive view about mutual funds. Mutual funds are investments vehicles that pool money from multiple investors to purchase a diversified portfolio of securities such as stocks, bonds, or other assets. What are mutual funds? Mutual funds allow individual investors to access a wide range of investments they may not be able to afford on their own. It includes professional management, diversification, and liquidity. Professional management means a fund manager with expertise in different asset classes manage the funds and investments. Diversification is investing in a mutual fund diversifies your portfolio across different asset classes, reducing the risk. Liquidity. Investors can easily buy and sell shares of mutual fund, providing liquidity and access to their funds. Key features and benefits of mutual funds. Mutual funds offer various advantages for investors, making them a popular investment option. It gives accessibility. Mutual fund is accessible to investors with a different risk tolerance and investment goals. It gives transparency. Mutual fund companies provide regular reports and disclosures about fund performance and holdings. It also enhances the tax efficiency of investors. Mutual fund can offer tax advantages such as capital gains, tax deferral, etc. It gives cost effectiveness. Mutual funds have relatively low expense ratios, making them an affordable investment option. Types of mutual funds. Equity funds. Equity funds invest primarily in stocks, aiming to generate capital appreciation and potentially which have high returns. It can be classified into three, namely large cap funds. It means invest in stock large established companies with a high market capitalization. Mid cap fund means it focuses on mid-sized companies with a moderate growth potential. Small cap funds includes those investments in stocks of small companies with the potential of high growth, but also it has high risk. Types of mutual funds on the basis of debt funds. Debt funds are those funds which invest in fixed income securities such as bonds, government securities, and corporate debt, aiming to provide steady income and preserve capital. Debt funds includes government security funds which invest in bonds issued by the government, typically considered as low risk. Then corporate bonds. Invest in bonds issued by corporations offering potential of high return, but also it has high risk. And money market fund includes short-term funds which have highly liquid debt securities, providing a stable and a low risk investment option. Types of mutual funds on the basis of hybrid. Hybrid funds combine investments in both equity and debt securities, aiming to provide a balanced portfolio with a mix of growth potential and income generation. Balanced funds includes a balanced mix of stocks and bonds suitable for investors seeking moderate risk and a potential return. Income funds are those funds which focus on generating regular income through investments in debt securities while also including a portion of equities. Types of mutual funds on the basis of specialized funds. We are having four types. One is sector funds, which invest in companies with a particular industry such as technology, healthcare, or energy. International funds are those investment in securities of companies outside the investor's home country, providing global diversification. Index funds are those funds with specific market index aiming to replicate the performance of the index. Socially responsible funds invest in companies that align with ethical and environmental values. We are going to see how we can go for selecting ourselves a right mutual fund. In order to choose a right mutual fund, which requires careful consideration of investment goals, risk tolerance, and time horizon. First of all, we have to define our investment goals, which determine your financial objectives such as savings for retirement or buying a home. Then we have to go for assessing risk tolerance, which understand your ability and willingness to accept potential loss in exchange of higher potential return. Then we have to consider your time horizon, which determine how long you plan to invest, as short-term and long-term investment strategies differs. After finding out our time horizon, we have to go for research in fund performance. As investors, we have to evaluate past performance, expense ratios, and fund manager experience. At last, we have to go for seeking a professional advice. Consult with a financial advisor to get personalized recommendation which tailored your needs. Investing in mutual funds is a step-by-step guide. First of all, we have to choose a mutual fund. In order to select a mutual fund, we have to go for opening an account. Then we have to find our investments, and finally we have to go for monitor the investment which we have made. As an investor, we have to go for finding out the risk and consideration of mutual fund investing. The risk can be calculated into four basic risk, because the mutual funds will be having a more diversification and professional management, but still it comes with certain risk. Market risk. The value of mutual fund shares can fluctuate with market condition, potentially resulting in the loss. Fund manager risk. The performance of the fund depends on the expertise and decision of its fund manager, which can vary. Expense ratios. Mutual funds charge fees known as expense ratios, which can impact return. Tax implication. Capital gain distributions from mutual fund can be taxable depending on the specific fund and your tax situation.